Now we're going to segue into our financial plan and fundraising. So, and Roz alluded to the business model. The financial section of the plan is like a mini plan in itself. It has its own structure and logic. And this is something that requires a lot of time and effort because we have to have a financial plan that shows that this is an interesting investment for potential investors. And we also have to make sure that our financial model matches our business plan. So if you haven't done financial modeling before, this can be a painful process. But when we work with companies, we also help with the financial modeling. So the logical structure of the financial plan is like this. We start out with the business model. So this is different from business model canvas. This is a financial business model. In this case, business model means what's our revenue model? What are our key cost drivers? Meaning, how do we generate revenue? And how do we, what drives our costs? This is, again, I mentioned earlier, this is a great area for innovation. So we can have an innovative business model as well as an innovative product. But when we get to the financial plan, now we're looking at the effect of that business model on our financial performance. Next thing we will include is our financial projections. So the financial projections will show, given our business model, what will our forecasted revenue and expense be. I like to do revenue and cost projections and a overall financial projection for 5 years. So we do 5-year financial forecasts for each of our companies. Now, financial projections for startup companies are a little bit of a debated area. The debate goes something like this. On the one side are people like us or me who say, we must do 5-year financial forecasts for each startup. On the other side are people who say financial forecasts for startups are nonsense. Because why?
Highly unpredictable.
What's that?
Highly unpredictable.
Highly unpredictable. Yeah. What was the other one?
There's no existing market.
So yeah, there's a lot of assumptions need to go into our financial forecasts, and therefore we shouldn't do. But I believe that this argument misses the point of financial forecasts. Actually, we can make the same argument about all financial forecasts. All financial forecasts are full of assumptions, and they're speculative, and they're about the future, and nobody really knows what's going to happen in the future. So if you look at the, let's say, track record of public equity markets, equity analysts, and the financial forecasts that they do for publicly traded companies, where we have a wealth of historical data and a well-known market, the empirical results are that those forecasts are no better than random in predicting what's going to happen in the company. So basically, no financial forecasts are effective at predicting what's going to happen in the future. Then you might wonder, if that's my argument, so my argument is all financial forecasts don't predict anything, therefore we should do for startups. Does that make sense? Seems contradictory. But the reason it makes sense is, what's the purpose of the financial projections? The purpose is not to predict the future. We're not economists. We're not trying to say what's going to happen, and we don't pretend to know what's going to happen. What we do, the reason we do financial projections is to see if our business model can work. We look at, given this business model and given any reasonable set of assumptions, is it possible for this company to be as profitable as we propose it's going to be? And our business model proves that. It proves that, our projections prove that. Given that we take the business model and we apply a reasonable set of assumptions to it, and it produces a profitable company, now we can prove that at least under one set of conditions this works. And we can do multiple sets of conditions and say it works under this set of conditions, it works under that set of conditions, which it's not given, right? We can take a business model that might make sense, but actually we haven't properly forecasted it. So in reality, no set of conditions makes it work. So that's how I use financial projections. And the other practical way that I think about it is, imagine, let's say there are two types of investors. Investor A requires financial forecasts or doesn't invest. Investor B thinks financial forecasts are nonsense. So if you don't have financial forecasts, you can only talk to investor B. If you have financial forecasts, you can still talk to investor A and B, because you just don't have to show your forecast to investor B. So you're better off with financial forecasts than without. Next thing in the financial plan is the valuation. Valuation means what? The value of your company. So when you're an entrepreneur and you start thinking about raising money, you're going to spend a lot of time thinking about your valuation, and you're going to be in a lot of negotiation with investors on your valuation. So in some ways, valuation is the most important number in your financial plan. Why? You have to go back to think about our financing method. We're raising money in equity investment. So imagine an investor wants to invest $1 million in our business, in our company, and in exchange we're going to give them equity. How much equity should we give them? How much equity should they receive? So let's say we want $1 million. How much equity should our investor receive for that $1 million?
Depends on the value.
Depends on the valuation. So the simple formula for figuring this out is investment divided by valuation. Does it make sense? Let's say my whole business is worth 10 million. If I get 1 million investment, how much equity should the investor get? 10%. If my whole business is worth 5 million and an investor puts in 1 million, how much equity should they get? 20%. So it's just like that. It's very straightforward. How much equity goes to the investor for a given amount of investment is determined by the valuation of the company. Now, of course, there's a huge difference in those two valuations. Correct? Like, if I give 10% or 20% to an investor, if I start out with 100%, I'm left with either 80 or 90. No, just kidding. So, you okay? Usually somebody gets excited at that point in a presentation. It's not uncommon. Okay. So, if right, because I have given double the amount of equity based on difference in valuation. So you're going to find this is a really important number, and we're going to spend a lot of time and energy in our financial model calculating your valuation. I talked about funding required, equity offered. Use of proceeds. So what are we going to use the money for? You're raising money from investors. Investors are going to want to know, what will you spend the money on? And they're going to want to know that in detail. So what are you going to spend the money on? On what? Just in general terms.
Salary.
Whose salary?
People who work for you.
The other people, right? Yeah. So generally we're going to spend, I'm going to follow up on that point in a minute. Generally we're going to spend the money on growth. We're going to invest, the investor invests in the company. Why? Because he expects that we're going to use the money to grow the company to increase the value. So all use of funds or all use of proceeds will be directly related to creating growth. Now, opinions about what creates growth can differ a little bit. Now, one question that comes up a lot or somewhat frequently during discussions of use of proceeds is how much of the investment should be used for founder salaries? Like, now we can start to see where although investor and entrepreneur interest with equity investment are very closely aligned, they're not perfectly aligned. They're aligned in the sense that we both want to radically increase the value of the business and sell it and make a lot of money. But they're not always aligned because we're in different positions. I'm an investor, you're an operator. You're operating the business. So how much should go to founder salaries? Like when you do your spin-off and then you raise some money, like how much salary do you want?
Reasonable amount?
What's that?
Reasonable amount.
Yeah, okay, so what's reasonable?
It's like maybe on par with, I don't know, the market standard or something.
So what's a market standard? I mean, what's your market?
Let's say, I don't know, on par with your previous salary.
Oh, at A-Star? You mean working for Singapore government, like the richest country in the world, like that? So no, but I'm teasing a little bit. But this is a very real factor and something to think about. Like, I mean, one good thing about being a researcher is relatively well paid. Maybe you don't think so, but compared to other people. But compared to startup founders, you're way overpaid. So when people leave research institutes, when scientists leave research institutes to start companies, they usually take massive salary cuts. Massive. Why? Because what's the standard of comparison is other startups, not research institute. Like, or big company. You're working at Microsoft or Apple or Google. You leave to start a startup, your salary is also massively cut. So this is something to think about when you decide, I want to become an entrepreneur. You should be aware that you're going to likely receive a significantly lower salary than your previous job, unless you were working in a fast food or other, extremely low-paying industries. Why? Why is it like that? Like, do founders' salaries contribute to growth? I mean, they do up to a certain point. And Casper made this point at the beginning, and I wholeheartedly agree. Like, if the founders are not being paid enough to work full-time, meaning they can't satisfy their basic material needs from working at this company, then that's a big problem because they're distracted and they're either overly worried about their personal financial situation, or they can't meet the bills and they have to do something else. Then that's a huge problem. So usually investors will say your salary should be enough to cover your basic living expense, and that's it. Why? Because founder salaries too high also are not good. They also not driving growth, because then if founders have enough money to do whatever they want right now, then they're not thinking about how to generate a big exit. So I'll talk about this more in the financial workshop, but this is definitely an important topic to think about. What is your real cost of living? And this will vary from person to person. Like, we work with a lot of, let's say, recent university grads who are doing startups. What's their real cost of living? Let's say you're a Singaporean recent graduate from NUS. What's your real cost of living? How much money do you spend every month on basic needs? What?
2,000.
On what?
Like housing.
Housing? You live at home. You live with your parents. No, you're a recent grad. You live with your parents. How much do you spend on food? Nothing. Your parents buy all the food. What do you really have to pay for?
Travel.
What travel?
We don't walk to work.
Yeah, okay, transit. So let's say your bus pass is how much? $200 a month? Okay, so $200 a month. What else? Zouk? No. What else?
Insurance.
You don't need insurance at this age? Why do you need insurance? So anyway, we pay recent grad like $1,000 a month. That's a real cost of living if you're a recent grad in Singapore. That's considered like, low but reasonable salary for a recent grad founder. A-Star researchers, okay, can pay more. But I can tell you it's definitely going to be a big drop from where you are now. And it's something to think about. Anyway, well, more detail in financial workshop. On the other hand, okay, just to make you more comfortable, but like if let's say you have a family, then your kid's school tuition is one of your basic living expense. The mortgage on your house, it's a basic living expense. So the way to figure out what your salary is going to be is add up all those things that you just can't live without. Doesn't include designer handbag or new car. Those are not things you can really live without, but then that'll help you get an idea what you're going to get paid. Okay, exit strategy and ROI. How are we going to sell this company, and how are we going to generate returns for investors, and at what level? So for us, almost all exits are trade sales. This is the reality in the market in general. There's 6 to 10 times as many trade sales every year as there are IPOs worldwide. And ROI, we target, I mentioned before, 30 times, but if we can get more than that, good. A little less than that, it's also okay.